Hi, everybody. I'm Dean Barber, founder and CEO of Barber Financial Group. It is May the 1st. Welcome to the Economic Update. Today, we're going to review a little bit about what the markets have done so far this year, where they're at today. We're going to talk about what's changed since the fourth quarter of 2018. We're going to discuss interest rates and the yield curve, all designed to give you more of an idea of where our heads are at today, what we're thinking about the markets, what we're thinking about the economy, and what some of the indicators out there are telling us today. Let's start with taking a look at the yield curve from a historical perspective. I spent some time on this last month. I want to spend more time on it today. But today I want the focus to be more around market reactions towards the end of economic cycles. Market reactions towards the end of economic cycles can be extremely violent. They can really look like they have nothing to do with the underlying fundamentals of the economy. And so when we ask the question, what's really changed since the fourth quarter of last year? There's really only one thing, and that is Jerome Powell, our Fed chairman's stance on what he's going to do with interest rates. As we entered into the fourth quarter of last year, he kept saying we're going to raise rates 4 times this year, we're going to raise rates 2 or 3 times next year. He acquiesced late December. Now the odds of a rate hike in 2019 have seemed to have faded. We don't know exactly what that's going to look like, but we do know that that's the only thing that's changed. The reality is, if you fell asleep on October 1st and woke up on May 1st, you'd think that it was pretty boring because the markets are almost exactly where they were on October 1st. The thing is, though, that corporate growth and global growth has slowed drastically. Corporate profits are slowing drastically, yet we seem to have ignored that, thinking that somehow the Fed is once again going to ride in on a white horse and make everything okay. But every economy has cycles. We have expansions and we have contractions. And as I said last month, contractions are nothing to be feared. They just have to be understood. And as I go through the data today, I don't want you to panic and say, oh gosh, we got to do something different. What I want you to do is understand that when we do the financial planning for you, we take into consideration the possibility of poor market conditions and economic recessions that could occur at any point in your lifetime. And those things are stress tested in your plan. So it's important that you sit down with your financial planner and your advisor here at Barber Financial Group to understand how your portfolio is positioned. Run that portfolio back through the 2001 dot-com bubble. Run that portfolio through the 2008 financial crisis. And if you don't like what it looks like, or if it causes your plan too much stress, then you need to have a conversation about what are my options and how do I make this to where it fits into what's comfortable for me overall. All right, let's focus here just for a minute on the end of market cycles, and I want to focus on the volatility that occurs at the end of market cycles. So as we look at this chart, I shared this chart with you last week, and this is the yield curve. On the left side here, you've got interest rates on the 2-year, the 5-year, the 7 and the 10-year Treasury, and you notice that it's inverted. You're getting higher yields on the shorter end of the curve. We're here in March of 2000, and we have a steep drop in the market. It's kind of difficult to see on this chart. We have a steep drop in the market, and then an immediate rebound where the market rebounds about to where it was before. So people could have been saying at that point in time, well, okay, we had that little drop, we had that little correction. In fact, we had a couple of those back here in 2000. The truth is we had 2 rallies in 2001, 2 rallies that both exceeded 20% within about a 4-month period of time. So what we're seeing in the first 4 months of this year is not abnormal at the end of a cycle. It doesn't mean that everything's okay and we're out of the woods, and just because Jerome Powell says I'm not going to raise rates anymore this year, that means that, oh, it's just continued, let's all good, it's off to the races. You've got to look further at the fundamentals that are underlying the economy and corporate America today. We all know what happened after the July of 2000. You started into the drop down, and ultimately ending in the early part of 2003. And then we had 2007 and 8 with our yield curve inversion here in really early in 2007, March of 2007. And yet, even though that yield curve inverted, which is pointing towards the high probability of a recession in the future, the markets continued on up, and they had a little bit of a correction here and then another leg up, and people are thinking, okay, well, it exceeded the high that it was before. Everything's okay now. And then all of a sudden, that next drop down, it didn't come back up. Yeah, there were some violent swings back up there. My point is this. At the end of an economic cycle, we're going to have the volatility. You see it here and you see it here. And then as we fast forward, we can see this volatility that we had back here in 15 and 16, but we also take a look at the yield curve over here and we know that we didn't have that inverted yield curve. So we note that what was really going on here was the end of quantitative easing. But as we fast forward into 2018, we notice that inverted yield curve that I showed you last month is still there. We're inverted here from the 2 to the 10 year, from the 3 month to the 10 year. And so it doesn't mean that a recession is going to happen in the next month or two, but it does mean that a recession is highly likely within the next 12 to 18 months. And many of the large institutional money managers that I have an opportunity to speak with on a regular basis are saying the same things, that we are seeing a slowdown in global growth. We're seeing a slowdown in money supply, and we're seeing a lot of different things that are happening today that are actually causing us to say we should be a little bit more cautious at this point than aggressive. With that being said, it's easy to look at what the markets have done this year and say, gosh, I wish I would have had 100% of my money in the markets so far this year. But as this thing rolls over, as it turns around, we've got to maintain the discipline, whether you're using one of our tactical investment strategies or whether you're using one of our passive asset allocation strategies or actively managed strategies. All of those strategies are going to perform differently at different points in time. And it's important that you speak with your advisor to understand all the strategies will work. They're just all going to look a little bit different, and they're going to do it in a different way. So understanding how you can stress test each one of our investment strategies through your financial plan is really critical. Let's take a quick peek at what's going on with markets so far this month, or in the month of April. So if we look at the markets in the month of April, you can see our best performing sector in the markets here is the NASDAQ. The technology heavy NASDAQ gained 3.73% in the month of April. The S&P 500 came in at about 2.8%, and the Dow Jones Industrial Average was the lagger at 1.57%. But across the board, we did continue to see strength. We've had some surprises come out in corporate earnings where some corporate earnings have beat estimates, but we have to remember that a lot of the estimates that were out there were estimates that were already revised lower. So just because we have some of the profits beating estimates, some of the top line numbers beating estimates, doesn't mean that we're still seeing growth in corporate profit. We're actually seeing a reduction in that. Now, as things rolled out here in the first quarter, it's very possible that the corporate earnings recession that I started talking about in the last quarter of last year may not be here in the first quarter of this year, in the second quarter of this year. Maybe it's the second and third quarter. But there's no doubt about the fact that there's nothing really fundamentally in an economic condition that has changed since the fourth quarter of last year. And I'll end this with saying the only thing that's changed is the fact that Jerome Powell has taken a pause on raising interest rates. Economies go through cycles. Every expansion is followed by a contraction. Nobody puts it on a calendar. A defensive style of management can sometimes be early. It can sometimes get it a little bit wrong. But once that real bear market hits, which it will because it always does, you have to understand how your portfolio is likely to react in that bear market, and most importantly, how it affects your overall financial plan. Because at the end of the day, everything comes back to your financial plan and you being able to live your one best financial life. Thanks for spending a few minutes with me. I'm Dean Barber, founder and CEO of Barber Financial Group. We'll see you in the office and talk to you soon.